Hi, everybody. In this video, we are going to talk about the remaining asset misappropriations. Typically, these are going to be non-cash, things like inventory and other assets. So let's chat about these. So up until this point in the last video, we talked about misappropriation or theft of cash, but other assets can be stolen as well. This is typically going to be things like inventory or supplies or equipment, any other non-cash assets that they might have. These misappropriations are going to fall into a couple different categories: misuse, unconcealed larceny, meaning unconcealed theft, asset requisitions and transfers, purchase and receiving schemes, and fraudulent shipments. We're going to talk about each of those. So first, the misuse of non-cash assets. So misuse is just a fancy word to say borrow. So we can either steal something or we can borrow or misuse something. Assets that are misused but not stolen can include things like company vehicles, company supplies, computers, equipment. These are typically things that will be misused. So unauthorized use of a company asset is fraud when a fraudulent statement accompanies the use. So if we falsify documents about the mileage that we used of a company vehicle while we were using it for personal use, that would be an example of a fraud. The cost of misuse could be difficult to quantify because how much is legitimate time, how much is false time. It could be difficult to quantify. But in cases where this misuse results in like loss of productivity, the asset gets worn out, or other cases, it could be a harmful crime. Unconcealed larceny schemes. So this is theft of a company property. Obviously, this is going to be a greater concern than just misuse. This can range from simple larceny, just walking off with the company property, to something a little bit more complicated, where like falsifying some of the company documents and records to conceal your theft. The management versus labor, sometimes people just assume that the fraud isn't going around them, and they don't, when things are just taken in plain view of everybody. But in other times, the employees do know what's going on, but they're fully aware that one of their coworkers is stealing. But maybe they have a sense of duty to their friends, or this management versus labor mentality where they fear that they'll lose their job if they report it. So when a high-ranking personnel or management is stealing from the company, the laborer doesn't want to report it because they're afraid that they would get caught. So that's that management versus labor mentality. And then finally, the fake sale. This is where we are stealing. This typically is going to involve an accomplice outside of the organization, where we have a fake sale and our accomplice is going to pretend to buy the merchandise and just walk off, and we won't really ring it up. So maybe you're working at a store and your friend comes through with maybe you're working at Walmart and your friend comes through with a whole cart of groceries, and you pretend to scan all of the items, but you really just bag them up and send them off. That would be an example of a fake sale, where you kind of pretend to make the sale so it looks legitimate to anyone that might casually be walking by, but you don't actually make the sale. On the flip side of this, sometimes they can actually then go and return the inventory that's been stolen and convert that inventory into cash. They obviously wouldn't have a receipt for that transaction, which is why they oftentimes make you have a receipt. So how can we prevent this theft of non-cash assets? So segregation of duties is always the big one. So requisitioning, purchasing, and receiving are the three areas that we would like to have separated. So the payable function should be segregated from all purchasing and receivables duties. We also want to have physical controls. So physically guarding and locking locked assets, locked restricted assets, access logs. So whenever anyone, when we have restricted access and only certain people can have access to the goods, we have a log of who had access and when they entered the room or whatnot. Having security cameras is also a good deterrent, as we've talked about in the past. And then having the physical inventory count. So a physical inventory count will compare what we say we should have based on our books and records and what we actually have. So in larceny, we're going to show that what we actually have on hand is much less than what our books say. So by doing that physical inventory count, that's a good way to pinpoint when we have some shrinkage or loss. And then finally, if we have some customer complaints, such as short shipments, so maybe the theft comes as, somebody ordered 1,000 units and we sent them 900 and held on to the other 100 for ourselves. When they get that 900 items and they ordered 1,000, they're going to count them and they're going to be like, hey, where are the rest of our items? So having a mechanism where someone who's not part of the purchasing or warehouse function is going to investigate those complaints would also be helpful. Asset requisitioning and transferring. So this relates to the movement of the assets from one location to another location. So anytime anyone has access, we're going to have the susceptibility. So how do we control that so that when we're moving from one area to another, we don't have that loss? So we should have employee requisitions material. They're gonna need a certain amount of material for their job, or they say they're gonna need a certain amount for the job, and then they steal, the extra. So when we have that overstatement of what we require, so we're doing a job, we say we need 100 yards of fabric, we only really need 50 yards of fabric, so we're going to take the other 50. So sometimes they'll falsify forms, and to get that from the stockroom. The obvious problem here is that the person who orders the merchandise will be the primary suspect. I took out the 100 yards of fabric. So the fraudster might just rely on poor communication and poor controls between the departments and hope that no one is going to piece it together. When inventory is stored at multiple locations or in different buildings, we have that opportunity. So we want to be aware of that. Purchasing and receiving. If an employee to purchase merchandise that the company does not need, that is called a false billing scheme. So when they're purchasing extra, like stuff that they really don't need. If the assets were part of the company's normal inventory, then it's going to be a non-cash scheme. So the difference between these two is, did the company actually need those assets, or did we just order extra assets so that we could take them? So that's the difference between a false billing scheme and a typical non-cash scheme. Falsifying incoming shipments. So as this indicates, we're going to say that we have a certain amount coming in, and we're going to mark it that fewer came in. So maybe we ordered 1,000 units and we got 1,000 units, but when we wrote the receiving report, we only said we got 900. So that would leave 100 units there that we would steal. Eventually, the company that's shipped the 1,000 units is going to want payment for those 1,000 units. So we're going to have to explain where that other 100 items went. So, so that's kind of the issue with falsifying incoming shipments. False shipments of inventory and other assets. So sometimes to conceal thefts of inventory, the fraudster would create a false shipping document and a false sales document to make it appear that the missing inventory was not actually stolen, but was actually sold. The document that tells the shipping department to release inventory for delivery is usually the packing slip. So that's what we would have. And by creating a fake packing slip, the corrupt employee can make it so that the inventory is fraudulently delivered to himself. And then the sale is on that packing slip, might be to a false person or a false company. And then when they don't get paid for it, it will eventually get written off. So again, having those fake sales, getting the goods shipped to you under a fake name, and then ultimately having those receivables age and go to either a discount and allowance or a bad debt expense when they ultimately are uncollected. Employees will here understate legitimate sales so that an accomplice is billed for less than delivered. That is another thing that we could do. So how do we conceal inventory shrinkage? So in all of these non-cash asset things that we're talking about, we're taking something and eventually we're going to have to cover that up. So how can we do that? So the key concealment issue here is shrinkage. So inventory shrinkage is the unaccounted for reduction in the company's inventory that results from theft. So that's what this that term means, shrinkage. It's a typical red flag for fraud because you know, where did that inventory go? So our books say that we should have, you know, $1 million worth of inventory. We do a count and we only have $800,000 worth of inventory. Where did that other $200,000 go? So the fraudster has to come up with a way to make the scheme undetected, and make it so no one knows or sees that we have these missing assets. So how can they do that? There's a number of ways. So first is altered inventory records. So inventory is usually tracked with two things. So first we have our perpetual inventory where we track what comes in, we track what goes out, and that gives us kind of our day-to-day balance of what we should have in inventory. So that's like our book balance. Then we have our physical count. So every now and then, or at the end of the year, end of the quarter, we go and count up everything and show what we actually have. So we have, you know, this comparison here. So we can either alter those inventory records, record fictitious sales and accounts receivable, write off inventory and other assets, or physically pad them. So we're going to talk about each of these next. So in altered inventory records, here we'll just change that perpetual inventory record so that it will match the physical inventory count. This is also called a forced reconciliation. So again, here we're just falsifying those records to make it look like whatever we have in inventory is what we're showing on those books. So we'll have this entry into our inventory account that will just, you know, force the reconciliation, force them to match. So those journal entries should always be investigated to make sure that they were legitimate. When a fraudster adjusts the inventory records to match the quantity on hand, we're going to have no sales transaction. We're just going to have this adjustment that brings them into balance. So maybe we want to create a fake sale to make it look like there was a legitimate reason for why our inventory decreased. So here, if you think about when you make a sale, you have the debit to sales revenue, credit to inventory, debit to cost of goods sold, debit to revenue, credit to accounts receivable, debit to cost of goods sold, credit to inventory. So you have those two journal entries. Well, when we're forcing an entry, we'll just have the inventory part, the cost of goods sold part. So when we would create the fictitious sale, we have the other side of that to make it look like we had a real reason for the inventory to go down. The problem again with this is we're going to overstate our revenue, we're going to overstate our accounts receivable, and eventually that's not going to get paid, and it's either going to have to be written off or applied to like a discount or an allowance account. So we'll see that write-off. So we can always track the write-offs to see if they have increased from a prior year or are greater than we thought they should be. So those are some of the things that we might look for. Another thing that we can do is we'll write off inventory. So, our perpetual record says we have $1 million, physical count says we have 800. That difference is just obsolete inventory. And therefore we can remove that inventory from the books. We can either do this after we've already stolen them, or we can do it as a means to steal in the future. Like, oh, I really want this computer, I'm going to write it off as obsolete and then I can take it. Either way, it's a way to, for the fraudster to eliminate that problem of shrinkage. The last one is physically padding. So here we try to make it appear that there are more assets present in the warehouse than there actually are. So those other methods really kind of dealt with the perpetual inventory records. This deals with the actual inventory that we're showing in the warehouse. So we're going to make it look like we have more. So maybe we have a bunch of empty boxes. So if we sell a bunch of shoes, we have a bunch of empty shoe boxes that look like we have shoes in them, but really they're just a bunch of empty boxes and they're not really there. Same with a wall of product. So we might have, a wall that looks like there's a whole bunch of stuff behind it. But if you were to, look through it, you'd see that the inside was empty. So either of these methods, physically padding, making it look like we have more inventory than we actually do. Another physical padding that I had heard about was like an oil company. So, if you put water and oil together, the oil is going to rise to the top. So someone they had a big oil tank and they put water in it, and then the oil was, floating on the top. So it looked like they had a full thing of oil when really it was just the little bit on the top that was full. Another example of physical padding. How can we prevent or detect these thefts? So we have 2 slides here on this. So the first one, like I've said on almost all of these, having good separation of duties is really important. In this case, we want to separate ordering, the person who orders the goods, the person who receives the goods, and the person who maintains the inventory records. Also, the person who issues payment. Those are the kind of the 4 areas that should be separated. We also always want to match our invoices with the receiving reports before payment. So also, in my audit class, I teach the 3-way match. So we should have a purchase order. We should have the receiving report. So we know what has been ordered. We match that with what we had originally, what we actually got, and then what we're paying for. So the invoice. So matching those things to make sure that we have everything correct. So packing slip or the sales order is matched to an approved purchase order, so we know what we're getting. And every outgoing shipment is matched to the sales order before that merchandise goes out. Also, as I had said, bad debt is an area where we can use to manipulate. So if we see an increase in bad debt expense, we might want to investigate that a little bit further. Also, we can use some data analytics and compare our customer shipping addresses to all of our employee shipping addresses to make sure that we don't have any employees shipping goods to themselves. And then finally, the last 4 that we have, reconcile the materials ordered for projects to the actual work done. So this is to make sure that we have the correct amount of materials. They aren't ordering extra materials so that they can steal them. We can also perform trend analysis on the amount of inventory that is being scrapped. So if they are writing off a bunch of inventory as scrap, so they're, scrap inventory is used in the process of preparing or making these finished goods. And if they are getting too much from the warehouse, producing a bunch and then scrapping the rest, but not really scrapping it, just taking it, we can do a trend analysis to see if that seems reasonable. Also, we would like to have assets restricted to only proper authority, to only those who really need to be in there. So making sure that assets are only removed with proper authority, not that not everybody has access, is a big thing as well. So that concludes chapter 4. Stay tuned for next week and have a great week.